Welcome to This Explainer. Today, we are peeling back the curtain on the actual financial realities of the ultra-wealthy. We're stepping away from those simplified internet headlines to look at the true mechanics of wealth, asset ownership, and the tax strategies that operate entirely behind the scenes. We're going to examine the real-world mechanics of how money actually moves at the highest levels of finance and how tax laws operate when you're dealing with hundreds of millions of dollars.
Okay, let's dive into this. I want you to imagine, just for a moment, that your investments suddenly increase by a staggering $100 million. Now let's be super clear about what just happened here. You didn't earn a $100 million salary. You didn't get some massive paycheck from an employer. Your assets, simple by existing and compounding in the market, just became vastly more valuable.
So here is the million, or rather the $100 million question. Do you automatically owe tax on that massive increase? I mean, it feels like you absolutely should, right? The number went up, so the IRS should get a cut. But the surprising reality is, well, not necessarily. And this right here is where the tax strategies of wealthy investors become incredibly fascinating.
Section 1. Understanding unrealized gains. This is the financial playbook.
Now, what's really interesting about this slide is the core difference between a normal salary and appreciating assets. The absolute key word here is unrealized. If you receive a normal salary, that's ordinary income, and it's taxed as such right away. But if you own shares of a company or luxury real estate, and those assets increase in value, you generally haven't sold anything yet. That increase is an unrealized gain. Under current U.S. tax law, in many cases, the tax event only comes when the asset is actually sold and the gain is realized.
Let's really lock this definition in. An unrealized gain is an increase in the value of an asset that has not yet been sold for cash. This is a massive distinction. Wealthy investors deliberately hold on to assets rather than simply liquidating them to sit on giant piles of cash. This exact definition represents the fundamental divide between ordinary income and profound, generational wealth.
Let's make this beautifully simple. Meet our fictional investor, Alex. Take a look at this chart. Alex owns $10 million worth of stock. Over several years, the market performs exceptionally well, and boom, now that exact same portfolio is worth $20 million. Alex has gained $10 million in sheer value. But here is the critical point. Alex hasn't sold a single share. The value has literally doubled, but because the asset hasn't been sold, that $10 million gain remains completely untaxed at this moment.
Section 2. The liquidity dilemma. What actually happens when you need $1 million in cash?
Let's move to and see how this builds, because wealth on paper doesn't pay for everyday expenses. You can't buy groceries with a stock certificate, right? So our investor faces two obvious choices to generate that liquidity. Option 1, sell some of those investments. Option 2, potentially borrow money using those very same investments as collateral. Let's weigh these out to see exactly how the wealthy navigate this situation.
Let's look closely at the first option, selling assets. If Alex sells part of the portfolio, Alex gets the cash immediately. Simple enough. But here's the catch. Depending on the asset, the original purchase price, how long it was held, and the investor's overall tax situation, selling an appreciated investment can create a capital gain, and that gain may be highly taxable.
Let's break down the math clearly. Imagine Alex bought a specific investment for $2 million and later sold it for $5 million just to get some cash. That difference is a $3 million capital gain. Once that sale happens, the gain becomes realized. The exact tax bill on that $3 million depends entirely on the specific circumstances and current U.S. tax rules. But one thing is for sure, the IRS will be collecting their share.
But there is another possibility here, and it's one heavily utilized by Wall Street and the ultra-wealthy. Instead of selling the stock, Alex could potentially borrow money using those assets as collateral. They can walk right into a bank and secure a massive line of credit backed by that $20 million portfolio.
Now here is where it gets incredibly strategic. A genuine loan isn't simply the same thing as income. Take a look at this authoritative stance straight from the IRS. It states, borrowed money generally isn't included in gross income because the borrower has an obligation to repay the lender. This isn't some shady loophole. It is perfectly legal under U.S. tax law. You owe the money back, so it's not treated as income.
So the crucial point is, a loan does not equal income. By borrowing against the portfolio, the wealthy investor gets the millions in liquidity they need right now. But because they haven't sold the appreciating asset, they don't trigger an immediate capital gains tax event. Their wealth continues to grow in the market, and the cash is secured.
It's brilliant. Section 3, reality checks and risks. Because yes, loans have costs. Before you assume this is just an infinite glitch in the financial matrix, we need a reality check. Borrowing is absolutely not free money. The bank still expects its money back, and these loans come with hefty interest rates and strict fees. Let's walk step by step through the devastating domino effect that can occur if things go wrong. Step 1, you borrow heavily against your portfolio. Step 2, the stock market crashes unexpectedly. Step 3, suddenly that collateral backing your loan drops significantly in value. The bank sees their security vanish, which leads to step 4, they call the loan. A strategy that looked brilliant on paper becomes a serious financial disaster, potentially forcing you to sell off assets at rock-bottom prices just to cover the debt.
And I should warn you, avoiding repayment isn't a magic trick either. If you default and the debt is somehow canceled, tax consequences can absolutely arise. The IRS explicitly states that canceled debt can generally become taxable income, subject to specific exceptions. The tax treatment depends heavily on what transaction actually occurred. It's about liquidity, asset ownership, financing, and risk all working together like a giant puzzle.
Section 4, the ownership game.
And this brilliantly illustrates a key point. How does this connect back to you? The big takeaway isn't that billionaires discovered some secret 0% tax code. The reality is that there isn't one single billionaire tax rate. The real advantage is the act of structuring your finances around owning productive assets, like businesses, stocks, and real estate. Because owning assets is treated very differently than earning a traditional salary. Ownership literally changes the game entirely.
Now sure, a traditional bank might not let you borrow against a $5,000 portfolio the exact same way they treat a $500 million one, but the underlying principle holds true for everyone. Here is the true path to building long-term wealth. You earn, you save, you invest, you relentlessly build ownership, and then you step back and allow those assets to compound over time. Don't just think about how much money you earn. Think deeply about what you own.
Which leads us to our final provocative question. It's time to stop asking, how do rich people avoid taxes, and start asking yourself, how is my wealth structured? Because true wealth isn't just about how much you make, it's about how you position what you own. If you want more breakdowns of how money and investments are structured at the highest levels, make sure you're subscribed. And stick around because in our next explainer, we are going to dive into the corporate world to break down Wyoming versus Delaware LLCs and explain which one actually makes sense for a beginner. See you then.